pivot over to Craig Bolanos. He's the co-founder and wealth advisor at VestGen Wealth Partners. Get retired, stayretired.com. Hello, Craig. Happy Wednesday, my friend.
Hey, happy Wednesday. And at least the futures are looking a little bit higher after the index snapped that 4-day losing streak.
Yeah, I wanted to ask about the general vibe right now. Markets aren't down all that much. We're down maybe 1% in the S&P over the past month. You're going to have months like that, a lot of them in your savings and retirement years. But what is the general vibe? Has it shifted a little bit? I'm getting the sense that maybe there's some more apprehension than the last time we talked.
Well, I think there's good, there's bad, and there's ugly. I mean, that conference board report where we figure out how people feel, you and I call that sentiment, John. What we learned here in the past several days is that more people are thinking about buying a house and moving in the next 6 months. That's good for the economy. That's the good news. The bad news, though, is when people are surveyed about jobs, they're starting to really report that the jobs are no longer plentiful and it's taking longer to get reemployed. And then what's ugly? Ugly is people, consumers' expectations for inflation. They're actually the highest they've been since 2023.
Well, what does it matter what people think about inflation? How does that matter? That doesn't change what actually I pay at the grocery store, does it?
No, it doesn't change your experience at the checkout line, John, but what it does do is this. Walmart told us about it last Friday. I think the noise level is so large from November until now, that's made it a couple of months. And this noise level being so loud, the rhetoric being so loud, is finally starting to show up in consumer feelings. And the longer the consumers feel like there could be higher prices to come, the more likely they are to hold on to their money and not spend. And that's not good for any of us because it's the consumer, the U.S. exceptionalism of the U.S. consumer that's powered our markets higher.
When inflation spiked really high in 2022, upwards of 9%, I think that was either June to June or July to July in 2022, 2021, looking back, the job market was still solid, and it is right now, right? The numbers still bear that out. My concern, and maybe this is where some trepidation is coming in, is if consumers think prices are going to go up, and we have seen a little uptick in inflation, and this soft job market becomes softer or it gets worse, those two things at the same time could, I don't want to freak anyone out, could spell problems.
It could spell problems, but let's remember there's where we could be in the future, and then there's where we're at right now. And, John, you and I talked about Goldilocks for 2 years in a row, an economy that's not too hot, one that's not too cold, one that feels just about right. And whether I look at manufacturing, I look at services, I look at capital expenditures, I look at anything, we're still heading to a soft landing. So I'm not saying that any of this policy-inspired volatility will cause an economic slowdown. I'm not saying any of it's going to sustain a market decline. It's way too early to make that determination, but we're starting to see indicators that could be in the future, and that's why people should be picking up the rebalancing protocols in their portfolios.
What do you mean by that?
Well, what I mean by that is right now, if we do end up having a growth scare, which is kind of what you hinted to, John, I would call it a growth scare. I know you've heard this before because you talk about it all the time. Having a balanced sector exposure is where people need to be. And when I say balanced, I'm not talking about your mix of stocks versus bonds. I'm meaning people should own things besides just technology. Look at what we've seen so far this year. Last year's loser, healthcare, happens to be the best performing sector this year. And I think people might want to just make sure they're diversified by sector, not just owning a bunch of mutual funds or ETFs.
A lot of people listening right now, their exposure to certain areas of the economy are probably going, yeah, I don't know. I have a 401k, I have an IRA, I bought some mutual funds that some guy told me to buy once, or I have a target date fund. Should these people that maybe listen to you and go, I don't know what my exposure is, either go to you or at least open up the hood themselves and see what's underneath?
Yeah, I think what you should do is, here, John, I'm going to tell you what. I love your radio program. You mentioned inflation. You and I talked about Series I savings bonds. You talked about treasuries. We've helped people so much. Right now, if someone doesn't know what their sector exposure is, let's go and do a risk intelligence exam to find out what's underneath the hood of all these mutual funds, ETFs, things that you own, whether it's your kids' 401, whether it's your 401k, your IRA, your 529 plan, because if you're empowered with knowledge of what you actually own and what it looks like when it comes together, then you can start controlling what you can control, which is your risk profile, or in this case, your sector exposure.
GetRetiredStayRetired.com. We're chatting with Craig Bolanos, and we got a few more minutes here with the co-founder and wealth advisor at VestGen Wealth. As we look ahead, President Trump saying tariffs against the EU would include a 25% tariff on autos, among other goods. Levies against Mexico and Canada, which have been paused for a bit, will go into effect on April 2nd. How do we analyze this? Because the last time there was this big run-up to the tariff threat, things kind of got worked out in, 12 hours. Do you think that plays into people's minds as they hear about more tariffs, wondering if, there'll just be some sort of a deal moving forward? Is that keeping everyone a little bit more calm right now?
Well, clearly the groupthink of the market, the collective wisdom of all investors around the globe is exactly that. And why shouldn't it be, John? You and I talked before on your radio program that this is Tariff 2.0. We lived through Tariff 1.0 in 2018 and 2019. And let's look at 2019. In 2019, we had 7 decisive pivots where the goalposts moved on tariffs in May through December. Doesn't it feel like we're currently moving the same goalposts? So I wouldn't be surprised that just like it took 7 months in 2019, it might take 7 months in 2025, but we should expect logical conclusions at the end because no one wants to toss a hand grenade into the global economy and blow it up, especially not a president who keeps score with the stock market and the jobs numbers.
I've often wondered the same thing as well. I mean, part of President Trump's and the reason why he has so many people supporting him is his idea that he's unpredictable, right? Certainly. And he likes to forward front that. And some of his policies do echo that unpredictability and the nature of him. But when it comes down to the actual decisions that are made, I wonder if it's like everyone kind of knows that he knows the stock market keeps the score, and that keeps his decision-making windows a little bit more narrower than some people think. Did that question make any sense, Craig?
It does. It's kind of that old statement, John. If you know that I know, which means we both know, which means everybody knows, what do we actually know? Okay, that was confusing. Here's what I think it means, John. The amount of outcomes aren't as wide and varied as people actually think. I think that's what you just said.
Yes.
Because ultimately tariffs are a math problem. Ultimately inflation is a math problem. Ultimately everything in finance is a math problem, and we can solve for math because it's a bunch of zeros and ones, and I think that's the world we still live in. So for everyone who's worried, and it's okay to be nervous, I think the sun is still rising in the east, which means you know what directions it's setting. It's setting in the west, and that same thing applies to where these tariffs are likely to end up across the global stage.
Chatting with Craig Bolanos, Get Retired, Stay Retired. Craig, we got an extra couple of minutes here before the news. I did want to dive a little bit into NVIDIA, which is the chip maker that was seen as the only one that had these chips powerful enough to run the future of AI. And then it turns out a hedge fund in China came up with, what was it called, DeepSeek, Craig, which was essentially showing that, nope, we don't need your good chips. We're able to run something that's just as good as ChatGPT or one of the other big ones that we know of, the AI. That drove NVIDIA down last month. That drove a lot, or earlier this month, I think. That drove other stocks down, thinking that we were the powerhouse country for the future of chips manufacturing. NVIDIA's sort of, kind of come back a little bit. Do we feel like maybe China doesn't have it figured out when it comes to AI, or do we feel like, for whatever reason, we're back on in NVIDIA? Maybe it was too much of an overreaction. What's your read on that?
All right, simple scorecard goes like this. NVIDIA just grew its sales 78% on AI demand, artificial intelligence, and they gave strong guidance. DeepSeek, which was the Chinese chatbot that came out, when it came out, it was so disruptive. We saw $1 trillion of stock market destruction in artificial intelligence stocks in a single day. John, $1 trillion.
Yeah.
But as time has gone on, everyone's taken a look at DeepSeek and said, wait a second, did it really only cost $6 million to create what it took hundreds and hundreds of millions for others to create? Probably not. But here's the takeaway. The takeaway is when people participate and invest in industries that are based on innovation that lead to disruption, the leading companies can just as easily be disrupted by a competitor that can come out of left field. And I think that DeepSeek story created some fragility in the price of some of these AI stocks, and we're seeing that reflected today because people wonder, is there going to be a more economically sensitive model going forward than paying up as much as people are paying up for Blackwell, some of the newest developments out of NVIDIA?
Yeah, just think of Netscape. Netscape was the internet browser, the golden child, until someone else came along and maybe did a little bit better. Yeah, we don't have to look too far in our past to see that with the tech world. Okay, we nerded out about AI, Craig, and that's when we're out of time. Got about 15 seconds left. Why should people be calling you? How should they be reaching out?
If you want to get retired and stay retired, it takes a dedicated team, and I encourage you to connect with me online. Get retired, stayretired.com. Common sense solutions. They're tested in the trenches with a family office environment for everybody.
TNT, baby. Craig, we'll talk soon, okay?
Sounds great, John. Thank you.